Hello and welcome to The Point. I'm Neil Stanley and this is episode 32 where we're going to talk about cost of funds. When it comes to cost of funds, we know that in the current situation that there are many dynamics. We have wholesale funding rising at a very fast rate along with investment options. We have competitive offerings. We have the loan to deposit ratios, the historical perspective on cost of funds relative to Fed funds. We're going to think about some of the new dynamics that have come into play. And that's going to lead us to some consequences and potential conclusions. So this is a graphic of the Fed funds history since 2017. And we can see what grew very slowly before 2019 has grown very rapidly in terms of Fed fund changes this year. And so I thought it was interesting to do a poll. Now, this is a poll of actual historical data, so it's more like a little quiz. What do you think happened the last time Fed funds hit 5%? And so I posted three options, as you can see there, and found out that the majority of people, slight majority, 51%, had the right answer. We'll talk about what that answer actually was going back in time. So the yields on treasuries have grown dramatically from the 1 year being at 0.4% starting the year and now at 4.8 just a couple days ago. The Fed Watch tool, as we can see here, is telling us that the Fed funds futures market is saying we're probably going to peak and plateau at 5.25. We see some of the competition out there for rates now with Synchrony, Ally, and Marcus. And so 3% for a simple savings account from Synchrony today. And certainly in the mid fours and upper fours for short-term certificates at brokers like Edward Jones. So what's going on in the balance sheets? When we look at the balance sheets of banks, we see the third quarter data is now available on the Uniform Bank Performance Reports. And so when we look at the average for loans to core deposits is now at 75% and just under 70% for net loans and leases to deposits. So if we go back just one quarter, we see that that same data set was 72% and 67.6%. So these are moving at a fairly fast rate for quarters. These move generally very slowly, and today these loan to deposit ratios are moving promptly with loans growing and deposits shrinking. So we went back and we looked at the history with the FDIC quarterly profile reports showing cost of funds, and of course taking the data for the Fed funds target rates and looking at what they've been over the history since March of 2004. We thought it was important to maybe consider then back when the last time interest rates were at 5% for Fed funds, what did the ratio of loans to core deposits look like back then? Well, considerably higher, with loans to core deposits being at 103 and loans to deposits at 80%. So 103%, much higher than the 75%. And that's certainly an issue that causes us to lag in terms of cost of funds. But there are also some other dynamics at play. So in the 80s, going back further, when interest rates were much more material, we didn't have any technology. Then interest rates dropped materially. They became somewhat inconsequential for most of the last 15 years, but technology became much more robust. So the other thing that happened in the last decade is we removed regulatory friction. We took away many of the restrictions on early withdrawal penalties. We took away savings withdrawal limits. We took away the prohibition on commercial accounts, DDA accounts having interest. So what keeps depositors from using today's technology to put their money to work risklessly? That's a good question. You know, for a generation now, they think that putting money to work means putting it at risk. Reality is with non-material, non-trivial interest rates, you can put money to work without putting it to risk. So media and social media messages are rampant today about inflation and interest rates. So what does this all mean to your institution at this time with a 4 to 5% Fed funds world? So let's look at the Uniform Bank Performance Report. We're going to look now at yields. And so we're looking here at the third quarter And when we see the 4% Fed funds target that we have now, with the cost of funds over here in the trimmed average at 49 basis points, that's only 12% of the Fed fund target. Transaction rates, 29 basis points, is 7% of the Fed fund target. Savings rates, 0.34, that's 9%. CDs, 82 basis points, that's 21% of the Fed fund target. Now let's look at loans. If we go up to loans at 5.02, and then compare that to investment yields, currently at 208, and Fed funds at 4%. All of this is telling us that we are going to see a material and significant increase in cost of funds. Because when we look back at the last time Fed funds were 5%, recognizing that loan to deposit ratios were different, they were much higher. But what we know is the cost of funds back then was 304 on this schedule. It was actually on the FDIC quarterly deposits, it was 312. This is the average of banks, so it doesn't give you a complete weighted average cost of funds. It just tells you that the average bank cost was 304, but 312 was actually the portfolio of all banks. Using this data, though, as the proxy that we have now, because it's available to us, we can look at transaction rates that were 117 back when Fed funds were 5. That makes it 23% of the target of Fed funds. Savings were at 203, 41% of the Fed fund target, and time deposits were at 394, or 80% of the Fed fund target. It's interesting, the relationship, because savings were about twice as much as transaction and time deposits were about twice as much as savings. And then when we look at the loan yields, we see a big difference, because the loan yields then were 775 compared to investment yields at 447 compared to Fed funds at 5. So there was a significantly greater spread over Fed funds, of course, because we had more time for those rates to take effect and be put into the loan yields. So we know this is true. Loan yields are going to rise. It's already baked into the cake. They're going to rise, but simultaneously, cost of funds is going to rise. And as a percentage, cost of funds is likely to rise even more than the loan rates. So what we want to do is be very mindful that as we find this environment where loan rates are going to rise back to the 4 to 5%, what is our cost of funds going to do as it moves off the 26 basis points that we were there in June up towards the 312 rate that we were last at when we were at Fed funds of 5. Now, we hope that the key to this is keeping a proportionality to what we're doing with our transaction accounts, our savings accounts, and our time deposits, respecting the various value propositions that they all hold. So when it comes to consequences, we're assured that nothing on your income statement is going to change in percentage terms as much as interest expense. Now, we're hopeful and optimistic that interest income is going to change in dollar amount as much, but as far as a percentage change, we think interest expense is going to be the big mover. Your team, engaging those depositors in treasury services and in retail deposits, needs to be on the top of their game today, being well trained and positioned to have those conversations that are coming about people asking whether they are content, curious, or actively rate seeking. What's that going to look like? How are we going to engage them? Recognizing that commercial borrowers are going to realize that their commercial DDA accounts could be invested someplace else for interest. They don't have to have a sweep account anymore to get interest on their commercial DDA account. So the money migration is going to severely test our interest rate risk models. And the assumptions that we've made about deposit pricing betas and decay rates are certainly going to be up for testing. They are going to be challenged. And we hope that you and your ALCO are looking at all the scenarios, considering all of the important aspects of engaging the content, the curious, and the actively seeking. So I thank you for your curiosity that leads you to continue to watch these To The Point episodes. I hope you've enjoyed this presentation, and I welcome you to contact me about your specific situation and how we can contribute to your success. Please use my Calendly link to set up a time that's convenient for you to meet with me. And I hope that you will join me for the next episode of To The Point.